You're doing everything right. And you're still falling behind. Not because of bad decisions, not reckless spending. You're watching the budget, cutting what doesn't matter, doing everything you were told to do. And at the end of the month, the money is just gone. That's not carelessness. It's not weakness. And it is not in your head. Here's something almost nobody is saying out loud. Official inflation is sitting at 2, maybe 3%. That sounds fine, like a slightly bigger grocery bill. Not like something that's quietly wrecking the finances of working families across the country, but then you open your health insurance bill. You look at what childcare actually costs. You do the real math, what's coming in versus what's going out, and something doesn't add up because that 2 or 3% number was measured in a world that looks nothing like the one most of us are living in right now. Today, I want to walk you through 6 specific things making it genuinely harder for ordinary families to stay afloat in 2026, not because they're being irresponsible, not because they're making bad choices, but because the cost of a normal life has fundamentally changed, and the old rules just don't apply anymore. Hold on to one idea before we get into it. The most dangerous part of what's happening isn't that prices are high. It's that you're being forced to spend even when you don't want to, even when you're actively trying not to, even when you've already cut everything you can. Once you see how this works, you'll never look at your monthly budget the same way again. Marcus is a high school teacher. Jennifer is a physical therapist, mid-30s, 2 kids, $91,000 a year before taxes between them. Most people hear that and think, okay, they're fine. That works. After taxes, take-home is about $6,100 a month. Here's their actual budget. Rent on a 2-bedroom in a regular mid-sized city. Not New York, not San Francisco, a regular city. $2,050. Groceries for 4 people. $1,050. Health insurance through Jennifer's job. $1,020 for the family plan. Full-time childcare for 2 kids. $2,250. Car payment, gas, and insurance, $640. Utilities and internet, $270. Student loans for both of them, $460. Total fixed monthly costs, $7,740. Monthly take-home, $6,100. That's a gap of $1,640 every single month before anyone goes to the doctor, before a tire blows out or something in the house breaks, before any of the normal things that just happen in a real life. Marcus and Jennifer are not eating at nice restaurants. They're not going on trips. Every dollar goes toward a roof over their heads, food on the table, healthcare, childcare, and getting to work. The most basic version of a functioning family life. And it still doesn't add up. When you run that kind of deficit month after month, it stops being a temporary cash flow problem. It becomes the foundation every financial decision gets built on top of. And the system, which has seen this coming for years and in many ways has been built around it, already has a solution ready. It'll lend you the difference. With interest. You're not overspending. You're paying to exist. And the question to carry through everything today is this. If the costs rising fastest are the ones you have absolutely no ability to cut, can we honestly still call this a personal spending problem? There are 6 things driving this. Let's go through them. Force 1. Housing. There's a story passed down through generations like it was just how things worked. Work hard, save up, buy a home, build equity. That equity becomes your retirement, your safety net, the thing you pass on to your kids. It was the foundation of financial security in this country. For a long time, it genuinely worked. It doesn't anymore. In 1985, the median home price in the U.S. was about 3.5 times the median household income. That ratio tells you how many years of your total salary it would take to buy the average house. 3.5 years. That was the deal. Today, that ratio is between 7 and 9 nationally. In bigger cities, closer to 11 or 12. The price of getting into home ownership has more than doubled relative to what people earn. Before you factor in mortgage rates that have made monthly payments even harder to reach than the sticker price already was. So what happens? People rent longer, they stay in smaller places, they move further out, and spend more time commuting. Or they spend more than the recommended 30% of income on housing, which squeezes everything else in the budget. That 30% rule, by the way, was set when homes cost 3.5 times income. Nobody ever updated it for the world we're living in now. Every month you pay rent, you build nothing. The money is gone. No equity, no asset, nothing to show for it. Meanwhile, people who already own watch their net worth rise automatically as property values increase. The gap between people who own and people trying to get in widens every year without anyone actually deciding to make it that way. Housing has become the single most powerful way that wealth inequality passes itself down from one generation to the next. But housing isn't doing this alone. There are two more things quietly doing just as much damage. Less dramatic, fewer headlines, and they're tied together in a way that makes both harder to escape at the same time. Force 2. The double bind. Childcare and student debt. One is something you're paying for right now. The other is a bill from a decision you made at 18. Completely different timelines, completely different origins. But they share one critical thing. They're both costs you pay just to participate in the economy at all. Start with childcare. If you're a working parent in 2026 with 2 young kids, full-time childcare isn't optional. It's the entry fee for keeping 2 incomes. Without it, one parent stops working, one income disappears. And given everything we've already looked at, one income almost never covers the bills, so you pay. No choice. The average cost of full-time childcare for 2 kids at a licensed facility in the U.S. is between $2,000 and $2,500 a month, more in expensive cities. That's more than the median monthly mortgage payment in a lot of parts of this country. You are spending every month what it would cost to own a home, just so you can go to work. The most honest way to describe it, childcare is a tax on having a job. Want 2 incomes? The system charges you for it. Can't afford the charge? You lose one of those incomes, which means it hits lower earners harder than higher earners. A mechanism that keeps people stuck financially instead of moving up. Now stack student debt on top. The average monthly student loan payment is between $350 and $500 per person. For a household where both people went to college, that's often $700 to $900 a month combined. This isn't money going toward anything you're getting today. It's a bill from a decision made at 18, when every adult, every guidance counselor, every institution was saying the same thing. Take the loans, get the degree, the payoff will come. That made sense with the information available at the time. The math stopped working somewhere along the way. Here's where it gets really punishing. Student loan debt affects your debt-to-income ratio, the main number lenders use to decide whether you qualify for a mortgage. So the loan you took to get the education that was supposed to lead to the career that was supposed to let you buy a home. That same loan is now the main thing standing between you and that house. Your past is blocking your future. The investment is eating the return it was supposed to create. Childcare plus student loans together, $2,700 to $3,400 a month for a typical dual-income family with young kids. That's a second mortgage. Except it builds nothing and leads nowhere except next month's exact same payments. Scale that across millions of families simultaneously, and you get exactly what we're watching. People put off having kids. They put off buying homes. They put off every step that was supposed to follow the degree. And when millions do that at once, it doesn't just change individual lives. It changes how an entire generation builds wealth. Or more accurately, how they're not able to. Now, housing, childcare, student debt, all painful, all visible, all on a bill somewhere. But there's something else that works completely differently. It doesn't just drain money. It makes you afraid to use something you're already paying for every single month. Force 3. The cost of not losing everything. Most people think of health insurance as paying for health care. It's not. Health insurance is paying to be protected from financial disaster if you ever need health care. That's a fundamentally different thing. And once you see it that way, what's been happening to the cost makes uncomfortable sense. A family paying around $400 a month for health coverage in 2015 is, in many cases, paying over $1,100 a month for the same coverage today. That's close to a 175% increase in 10 years. Over that same period, wages went up roughly 40 to 50%. Insurance costs nearly tripled. Pay went up by less than half. Every year since 2015, health insurance has quietly taken a slightly bigger bite out of household income with no reversal in sight. What does $1,100 a month mean in terms of what else you could do with it? It's a fully stocked emergency fund built in a year. It's steady retirement investment that, compounded over decades, would actually change your life. Instead, it buys you the possibility of not being financially wiped out if your kid breaks an arm. And here's where it gets heavier. You pay that $1,100 every month without fail. Then something happens, and you actually need to use the coverage. And you find the copay, the deductible, the percentage you still owe above the deductible, the separate bill from the radiologist who was in the same building but wasn't technically in your network. The product doesn't cover what you assumed. It covers part of it, after a threshold, with exceptions. Described in a document most people don't have time to fully understand. What that creates, multiplied across tens of millions of households, is a quiet daily calculation that has nothing to do with health. Is this symptom bad enough to justify the out-of-pocket cost? Can we wait? Should we hold off on the follow-up? You're not weighing your health against something you want. You're weighing your health against your rent. No one being financially responsible should ever have to make that call. But it's been baked directly into everyday life for a huge portion of working families. If health insurance costs are going up at roughly 4 times the rate wages are rising, and coverage isn't getting meaningfully better, where's all that money going? There's no clean answer. The system involves insurers, hospitals, pharmaceutical companies, and layers of policy. But the people writing the check every month deserve to have the question asked now. Everything so far lives on a bill somewhere. But there's a force operating underneath all of them that turns a hard situation into one that keeps getting harder. It doesn't live on any bill. It lives in the gap between what's coming in and what needs to go out. Force 4. When the shortage becomes the product. A typical 30-year-old in 1990 had around $5,000 in debt. A car loan, maybe a small credit card balance. Manageable. Had an end date. The average 30-year-old in 2026 carries between $75,000 and $85,000 in combined debt. Student loans, car financing, credit cards, personal loans. Think about what $80,000 represents as lost opportunity. It's 5 to 7 years of retirement contributions that never happened. The down payment on a starter home that never got saved. The financial breathing room for a real career. Risk. Starting something. Switching directions. Getting a qualification that would actually move the needle. A decade of options. Gone before the real part of life even starts. Here's exactly how a monthly gap turns into something that lasts years. Fixed bills, housing, childcare, healthcare, transportation. add up to more than what's coming home after taxes, not by a crushing amount, by a few $100s, maybe a couple thousand. So the household does the only sensible thing available: use credit. A card covers October. A personal loan handles February's emergency. The 0% plan takes care of the washing machine in April. Every one of those decisions is reasonable. It's what a responsible person does when the math doesn't work, and the alternative is missing rent or skipping a kid's doctor visit. But every decision comes with an interest rate, a fee, an obligation stretching into future months, which leaves less room then, which sometimes opens another gap, which needs another solution. October's gap becomes November's interest payment, which makes December tighter, which sometimes creates a new gap. The wheel turns, and someone is making money every time it does. When the gap between what life costs and what people earn is structural and consistent, not because of one bad month, but built into the math of everyday life, debt stops being a short-term fix and becomes a permanent part of the budget. Permanent debt means permanent interest payments, which raises what it costs to live, which widens the gap, which creates more need for credit. Being in financial difficulty in 2026 doesn't always mean having no income. Sometimes it means having income that's just consistently, structurally, a little below what it costs to get through a normal month. That kind of difficulty renews itself automatically because the product built to help you manage it, credit at 20 to 30% interest, isn't designed to get you out. It's designed to keep you in it for as long as you can keep paying. Force 5. The price you didn't agree to. You're buying 2 tickets to a basketball game. Listed price, $55 each, $110 total. By the time you hit confirm, there's a service fee, a facility charge, an order processing fee, and an insurance add-on you have to actively hunt down and decline. Your $110 is now $151. You finish the purchase. Because you've already spent 25 minutes on this. Because what's the alternative? Or you're booking a hotel for a family trip. The search page says $139 a night. At checkout, there's a resort fee, a destination charge, and taxes that weren't in the original number. The room is $189. You book it because the kids are already excited, and backing out feels worse than paying the difference. Or you're at a counter service sandwich shop. The cashier turns the payment screen toward you, 18%, 20%, 22%, and in smaller text, no tip. The person who made your food is 2 feet away. You tap 18. Even though you carried your own tray, poured your own drink, and will clean your own table. Each moment is a few dollars, but everyone was specifically set up. Through where options are placed, when information appears, how big the buttons are, to make the more expensive choice happen automatically. There's a term for this in behavioral economics, drip pricing. The attractive number goes first. The real cost arrives in pieces at the end when you're already committed. And at that point, backing out genuinely feels more expensive than just paying the fee. This isn't accidental. It's engineered by people who study how decisions get made under pressure. The total adds up. Analysts estimate the average American household pays between $1,500 and $3,000 a year in fees and surcharges that weren't part of the price they thought they were agreeing to. That money doesn't show up in inflation figures. It's not in the CPI. It exists in the gap between what things look like they cost and what they actually cost. When someone says people are spending beyond their means, it's worth asking, beyond which means? The listing price? The checkout price? Those are routinely different numbers, and that gap was built to be just small enough that you go ahead and pay it. The fee economy is businesses passing rising operating costs sideways onto customers in a way that feels less noticeable than raising the price outright, and the rising cost driving that connect directly to the final force, which isn't just pushing costs up, it's simultaneously pushing down on the income supposed to cover them. Force 6. The efficiency that never reached you. Walk into the fast food place near you. Count the people working the counter. There used to be 6 or 8, now there are 2, maybe 3. Everything else has been handed to touch screens and apps that don't need wages, benefits, or sick days. Walk into a bank branch, there used to be 4 tellers, now there's 1, mainly pointing you toward the ATM or the app. The mortgage team that used to work there now lives inside an algorithm. Walk into a grocery store. Self-checkout outnumbers staffed lanes. You scan your own items, bag them yourself, process your own payment. The work people used to get paid to do has been transferred to you, at no reduction in the price of anything in your cart. The standard economic argument, automation brings labor costs down, savings get passed to customers as lower prices, everyone benefits. But look around. Is the burger cheaper than 5 years ago? Is it cheaper to maintain a bank account? Are the groceries less expensive? The ones you're now scanning and bagging yourself? For the most part, no. Prices kept rising even as workers were removed. The savings from automation aren't reaching you. They're being captured elsewhere. And the workers who lost those jobs didn't land in better paying ones. Many ended up competing for fewer positions against a bigger pool of people, which pushes wages down, reduces household income, and widens the gap between what life costs and what people earn. Costs going up on one side, earning potential getting squeezed on the other. The gap filled with debt, the debt building interest, the interest adding to monthly costs, the whole cycle continuing. The productivity gains from automation are real. More output per worker, more value per hour. But who benefits from that efficiency has shifted steadily over decades toward people who own capital and away from people who do the work. If you own the system that replaced the workers, efficiency pays you. If you were one of the workers replaced, you carry the cost. And here's what ties directly back to Force 5. The same businesses that cut labor costs through automation are the ones with the tip screen at the self-service kiosk, the processing fee at checkout, the surcharge on the app order. They captured the savings from removing the labor. Then, they built a system to pull a little more from the customers those automated systems now serve. You're doing more of the work, paying full price, still being asked to tip. This isn't a coordinated scheme. It's separate businesses each doing what makes sense individually. And the result, added up, is something millions of working families feel even when they can't name it. No matter how hard we work, the ground keeps shifting under our feet, all 6 together. Because individually, each is a problem. Together, there's something different. Housing disconnected from wages, ownership out of reach, renting a permanent financial drain, childcare costing as much as a mortgage, making family formation a financial risk, student debt pulling the past into the present, blocking the asset building the education was supposed to create, health insurance functioning like mandatory disaster protection, rising roughly 4 times faster than wages while still leaving families exposed, a fee economy hiding real costs, quietly pulling thousands from budgets through design choices most people never consciously notice, and automation squeezing income opportunity at the exact moment it was supposed to be creating it. 6 things, all moving the same direction. Costs going up, income flat or shrinking, debt filling the gap, interest on that debt making it cost more to live, which creates more need for debt. What you end up with isn't a rough patch. It's a situation where ordinary life has been priced beyond what ordinary income can reliably cover, where the cost of just existing, a home, staying healthy, having kids, getting around, getting educated, has stopped feeling like a set of choices and started feeling like a subscription you're locked into whether you can afford it or not, one that charges extra if you fall behind. Now think about what that does to a person, not their bank balance, to them. You did the things you were supposed to do. You picked a career, got the education, built a household, managed money carefully. You're not reckless. You pay attention. And still, every month it comes up short. Every year, the distance between where you are and where you thought you'd be is bigger rather than smaller. That feeling isn't made up. It's not poor planning or lack of effort. It's an accurate read on a situation where the rules changed while you were playing. And no one stopped to say so. Personal finance culture always has the same answer. Spend less, cut more, be more disciplined. And personal responsibility is real. Choices matter. That's worth saying honestly. But there's a limit to what personal choices can do when the problem is structural. Cut every non-essential. You still pay rent, still pay insurance, still pay for childcare if you want to keep your job, still make debt payments, still hit the fee at checkout. You could cut down to almost nothing, and the structural gap between what things cost and what a normal income covers would sit exactly where it is. Tightening the belt only helps if the belt is what closes the gap. When the gap is built into the structure, baked into what it costs to live a basic stable life, cutting back doesn't close it. It just moves the blame. It reframes a structural problem as a personal failure. And that reframe keeps everyone focused on individual behavior instead of on the system that created the situation. So let me ask you something honestly, not rhetorically. I actually want to know what you're seeing. The people around you, your kids, co-workers, neighbors, the ones doing the right things and trying hard, are they getting somewhere? Building towards something slowly but steadily? Or does it look like they're running in place at best, slowly falling behind at worst, with the gap between their effort and their outcomes just getting bigger? Because if what you're seeing matches what I've laid out today, the conversation we actually need isn't about personal finance, habits. It's about what it costs to live a normal life, who built that cost structure, who benefits from it, and what it would take to change it. The 6 things we covered are not natural forces. They're outcomes, results of specific decisions, specific market structures, specific incentives built over decades by institutions with real power to shape the environment everyone else lives inside. That's actually not hopeless. It's clarifying. You endure natural forces. Structural outcomes can change when the conditions that created them change. But nothing changes while people are diagnosing the wrong problem. While a structural failure keeps getting called a discipline failure. While 2% headline inflation gets quoted while real families deal with what feels like 15 to 20% increases in the things that actually take up most of their budgets. While the loudest advice is still about cutting discretionary spending from budgets that don't have any left. The first step towards anything useful is an honest description of what's actually going on. For more and more working families in 2026, the cost of a normal life, not extravagant, just normal, is more than a normal income can reliably cover. That gap is structural, not temporary, not mainly caused by individual choices. And the system that benefits from that gap has every reason to keep it exactly where it is. You are not failing the system. In a lot of cases, the system is failing you. And being clear on that difference, really seeing it, is where anything useful has to start. If any of this matches what you're going through or watching happen to people around you, I'd genuinely like to hear about it in the comments. The most useful information in a conversation like this doesn't come from reports or data. It comes from people actually living this, trying to make a real life work inside the economy that exists right now. Hit like if this was worth your time. Subscribe if you want to keep having conversations like this, the kind uncomfortable to say out loud but necessary to have. I'll be back soon.